Hi there, just read this disclaimer please.
Alright folks, so it's that random day of the year, well it was 2 days ago, the 6th of October, when I randomly started my unitisation of the portfolio. So it's kind of the time of the year where I kind of collate the information and see how I'm doing. You will be unsurprised to hear that I'm not doing very well. So anyway, let's have a look. So there we are, that's the kind of the time point where I randomly decide to kind of take stock. So as you can see there, in the year the accumulation price went to 1.0556 from 1.16, so it's down. Well, let's go to the yearly tab of the spreadsheet here where it shows you. So as you can see, it's gone. I've just kind of copied the numbers across, so it's gone from 1.16 down to 1.05, so it's a total loss of 9.05%, and everything's taken into consideration. Now the Life Strategy 100, which is kind of what I benchmarked myself against, was only down 0.29%. So yet again I'm losing. As you can see, I've been losing for 4 out of the last 5 years, and the 1 year that I did beat the Life Strategy 100 was by a smaller margin than I've been losing on the other years. So yes, I don't know. In terms of it, I think I need to accept that because I'm in retirement, I shouldn't even be aiming for the best total return. I should be going for what makes me comfortable. And I still couldn't imagine buying something like that doesn't pay an income. It just doesn't feel right to me. It doesn't feel right that I would be losing the kind of steady increase in the income, which we'll come to now, because as we can see, cumulative dividend per year per unit is calculated here on the right, the column P, and as you can see, it's gone to 0.31 from, well, there's a few different ways this gets calculated. The income per unit, that's the fair way of doing it. So this is how the dividend per unit has increased regardless of inflows or outflows to the portfolio. So as you can see here, on the 2nd of January there was an inflow of 1,307 quid, which would have, I can't remember exactly where that went, but depending on how high yielding it was, that would have increased the dividends that the portfolio paid. So this column calculates the income per unit of the portfolio, stripping out the effects of that. So as you can see, the dividend rose by 9.79%, so from 0.28p to 0.31p, and that's just like the portfolio growing. Obviously sometimes that's because I've swapped investments when I've put money in the ISA, and for other parts of it, it's just the investment trusts or companies growing their dividend naturally. So you're 9.79% up. And then if we just look at the total income, so this includes the effect of adding that 1,307 quid. We can see that the income went from 10,318 to 11,384, which was a rise of 10.34%, which makes sense because it's a little bit higher than the income per unit, which makes sense because, you know, about 1,300 quid was added to the portfolio. And then here I've just collated where I've added on the cash that I get from the LISA bonus, and the SIP bonus just gets added here. As you can see, I didn't have the LISA there. If you look at the formula here, you can see it's just the same as column I. And then for that year, it had £1,000 added to it because the LISA, I started the LISA that year, and then the next year it was just a LISA again, 1,000 added. And then that year I had an extra 720 because I opened the SIP, and then again for that year I had the SIP and the LISA, so that's why the number jumps. And as you can see here, I've just made a little note. That was actually not in that year because I opened the SIP just before April, and then I used the second year's allowance just after April. But to make these numbers kind of smooth out, I've put that in the year before. And then so if we, obviously because the ISA bonus and the SIP bonus are static, that reduces the percent change in my total income, including those bonuses. which, so yeah, that makes sense because any increase does not happen to the SIP. In fact, I haven't actually looked into this properly, but I believe there was a 1% reduction in income tax at the basic rate in the latest mini budget, which was humongous. So actually I think that 720 quid bonus might be reducing by 1/20th, I'm guessing. Haven't actually looked into that. I've just done my September's budget spreadsheet update, so I've only got one. Don't ask me why, I've no idea why. Oh, I know why. It's because I moved into the caravan on the 3rd of November. I started monitoring my spending on the 3rd of November, so that's why I've got dividends and returns being measured to the 6th of October, but my spending is being measured to the 3rd of November. I think these spreadsheets and the way I measure things have just evolved kind of randomly, so that's why, you know, if you were designing this from the start, you'd make it all make sense, wouldn't you? You'd align the dates. But so because of that, I've got 1 month left of spending to add up, but my best estimate based on the 11 months I've already got is that I'd spend 10,100 to the 3rd of November. So that's let me save in this tax year, in this year to November the 3rd, I'm saving about £3,000, which is good because that gives me a bigger cash buffer for if I decide to go travelling the world and spending a lot more money. So as usual, it's doing well on the dividend front, doing badly on total return, and hopefully who knows, one day the dividends will be the best total return, and it will magically make this chart look a lot better, because as you can see, obviously the red line is not comparable to the green line because that's the accumulation unit. So as you can see, the blue line and the red and the green line are quite far apart. I would be much better off now had I just gone for a tracker, and in fact I'd probably be even better if I'd just gone for a global tracker instead of one which kind of skews a bit to the UK. This one does. I think it's, you know, people feel happier in their home market, don't they, so they overweight it, the UK. Okay, so and here's another chart, the same chart but just for the 12 months that we're monitoring here, and as you can see, for a very brief period there I was actually winning. Didn't last long though, did it? Okay, and then the value chart. Obviously this is like ignoring the unitisation. It's just monitoring my actual value, and you know, at the height it was almost 400 grand, and we're down now on the 6th we were down to 329 grand. Okay, so I mean, just not much to say here, but I thought I'd just show you where the incomes come from in that year. You'll notice this number here doesn't match the number from a unitisation, because the number from a unitisation is 11,384, but the total income I've got is 11,448. Basically that's just the charges. It's the Hargreaves Lansdowne and the AJ Bell charges that get taken out of the account. That's why I prefer iWeb, because iWeb you only get charged when you do something. You get £5 for each trade, whereas this just takes a little bit each month, and that's why that number's slightly higher, and I just couldn't be bothered factoring it in when I was doing the unitisation, so that's why that number's a bit lower, because obviously I only take out here what's in the accounts themselves, or what's actually being taken out of the accounts themselves. And this is just a record of what I've been paid. So as you can see, there's the numbers and how they've changed from year to year for each one. As you can see, I've already got the first one from GSK on the 6th. It happened on the day I did the valuation. Oh, you'll notice one thing here, that little note there. You'll notice there's only 3 payments there. This is part of their kind of cash flow issues they're having. They haven't announced this, but actually, as you can see, there's only 3 payments that fit in there now, because they've moved the dates of the dividends. So, I mean, it doesn't bother me. I'm fine. It's not like it hinders me. You know, I still own the cash they haven't paid me yet, because it's part of the net asset value of the company. Let's have a look now at where these returns came from. These losses. So I went to the AIC's website like I did this time the year before, and I got the total return of each of the investments. And then for these individual companies, I kind of worked it out myself, looking at the share prices and the amount of dividends I'd got paid in the year as well, and roughly worked it out. So as you can see, I've kept the year before's returns as well. Lowland's not doing too well. It's suffering the same as BlackRock smaller companies. These smaller UK companies are really suffering this year, so that's why those two have done really badly. Well, it kind of makes sense because Lowland's not all smaller companies. It's kind of a what's it called, multi-cap, is it? Multi-cap fund. So there's a variety of sizes of company in that one. That's why it's kind of it sits in between the returns of these two UK bigger company ones. Mind you, they have some element of smaller companies as well, but not as much as Lowland, and not quite as bad as BlackRock smaller companies. Finsbury are sold anyway, but yeah, that was down 2.61, so it's done better than the overall portfolio. And Brunner, which replaced Finsbury, had a similar return. JP Morgan smaller companies, kind of not too bad, kind of fits with the overall portfolio. Aberdeen Asia Focus didn't do too bad either. Obviously, Montenegro European company. Now, I think most of that, I mean, I am 20% down, I think, last time I looked. Where are we? Yeah, I'm about 20% down. So obviously, a lot of that 43% came before I bought it. Which isn't saying much, because the thing I sold to buy it, I think it was the Japanese Momentum Fund. That was down by a similar amount as well. So it's not like I've shielded myself from the whole of that 43% loss. Murray International's had a really good couple of years. My top performer this year, and it did pretty well the year before as well, 19% and 19%. Henderson International plodding along, doing pretty well. It's the value ones, those ones. Hint there. Scottish American, kind of value but kind of growth as well. Scottish American is, it's kind of dividend focused, but a lot of high growing companies, so that's why it's not done as well as the more value focused international income trusts that I own, these two, and not as well as the UK ones either, apart from Lowland. Fundsmith hasn't done too good, but I mean, considering the growth stocks are the ones that have been hit this year, and Fundsmith is a growth focused unit trust. Is it unit trust or like, I forget, it doesn't matter. To me, they're pretty much the same thing anyway. 7.22% down isn't that bad, considering its function is to be a growth fund. It's in the growth part of my portfolio, and it focuses on growth mostly. So that's not too bad, really, considering. Although I am closely monitoring it. I am thinking about just going for a tracker, maybe a S&P 500 tracker instead of it at some point, just because it'll boost my income by about 200 quid a year, and hopefully keep the growth prospects just as high. Although, if the markets over the next few years, if value does well, then it kind of stops being a growth fund, doesn't it? Because the S&P 500 will become more and more filled with value kind of stocks. So it kind of, even though it might do better, the S&P 500, the function of Fundsmith in my portfolio is to be in the growth section. So I don't know, I'm very much in two minds on that. I mean, Fundsmith isn't fully growth though. It does own things like Philip Morris. There is a handful, maybe 3 or 4, kind of maybe 4% dividend yielding companies. So it's not like it's completely growth, but definitely tilted towards it. And obviously, it's obviously Scottish Mortgage is just ultra growth. So that's no surprise that that's one of the worst performers. Is it the worst? Well, it's the worst performer that I've owned for the whole year anyway. And obviously Hypnosis, I spoke about that in the last video, which it's having a bad time with cash flow and refinance. Oh, it announced that it refinanced its loans and it's hedging it as well, but it didn't tell us anything about the cost of that hedging, hedging the interest rates they're paying on those loans. So I'm not so sure that it's how good a deal it is and how much it's costing them to do that. And biotech, they're kind of, obviously they're all growth focused, so they haven't done too well, but 13-14% down for the impacts environmental markets. And Shell obviously done well, but I've sold it now. I have no doubt, I'm trying not to look, since I sold it, I'm trying not to look and compare the performance of Shell to the performance of BlackRock smaller companies, because that was mainly what I put it in. I put most of the money into that. I have no doubt whatsoever that Shell is going to be flying, and I bet natural gas prices and oil prices have gone up since I sold it, and it's probably doing much better than the things I bought. I'm trying not to look, because I just know every time I do make a move like that, it ends up being the wrong decision. And then Barclays and NatWest. It's weird that NatWest is doing so much better than Barclays. Had a big dividend as well, NatWest did. Well, that's part of the return that's shown here, so. But shouldn't really matter. Anyway, that's where the returns have come from. Oh yeah, and if you look here, just as a side note, you'll notice now that I'm calculating cash dividend as 2%. I feel like every week there's a new bank account that's got the best easy access account. So now my cash is with Virgin Money savings account that comes alongside with their current account. That's the highest one at the moment. I wouldn't be surprised if by next week it'll be back to Atom or Zopa, my two savings account that I have. I've just kind of kept 100 quid in each of those just to keep them ticking over, because at some point, no doubt, one of them will be the best account again, and I can just transfer the money quite quickly. As to this spreadsheet about me going travelling the world, I don't know if you're familiar with this one, but I updated these numbers a few days ago, I think it was. Oh no, actually it was probably a couple of weeks ago. It was a couple of weeks ago, and what I've done is I've just put in all of the amount of cash I've got, and I subtracted 600 quid from my Lloyd account, because November is the month where I pay for my car insurance, and I also pay for my car MOT and service. So I've added 600. I've taken 600 quid away from my balances here. I've put in a £6,000 for selling my car whenever it might happen, and here's the how the numbers look. Oh, that number needs changing, doesn't it? I reckon that's higher now, because I only keep a few hundred quid in my Lloyd account, and I'm getting 2% interest on the vast majority of my cash. So maybe if I go to 1.75, very rough estimate, I've no idea how accurate that is, but I think we can presume 1.75% now. I mean, that's not going to be forever though, is it? That could easily go down or up, who knows, in the future. But you would hope, if it went down, you'd hope that the value of all of my growth style investments would go up, wouldn't you? So I don't think it's a risk to put a high number in here and have it reduced. And it's the same minus 55%, because I've put that static as at 80 grand, because at one point I calculated that the reduction I've already had reduces this 63% reduction in the NASDAQ 100 that happened in 2000. It reduces it to a minus 55% in the first year, because I've already gone from like 107 grand or something down to 80 grand. So the first part of that reduction has already happened, hence that number's a bit lower. Well, higher, sorry. It's a lower absolute number compared to that number. So yeah, here's a simulation of this worst case scenario. And as you can see, it has me going into the negative here. You know, who knows? I've hopefully put in a pessimistic number for my car being sold. And obviously at some point, if the growth shares, Fundsmith and Scottish Mortgage, etc., if they have a recovery, I could sell some of that. But anyway, here we are now. So if I didn't get a chance to sell any of my growth stocks, let's see what number I can go down to. Right, let's go 1,000. If I just subtract 1,000 from the spending each year, so my first year will now be 18,380. As you can see, I now make it all the way through. So let's see how low this number can go. I think 500 is going to be too little. Yeah, I need to go more than that. So if I take off 600, nope. 800, yeah. 700. I should have known I had to go up in bigger increments than this. There we go. 765. Let's try it. There we go. So there we go. That's how close I am now. I just need some more progression. So worst case scenario, I could give away the caravan because it's in such a state and just spend 765 quid less than my budget every year. So now let's have a look. So let's not spend less. Let's just keep the budget as it is and see how much further I need to go. So let's say if I wait until May, and by the end of May I've got an increase in the dividend of 200 quid. Does that do it? Nope, still goes into the negatives. Here, that's what we're looking, by the way. So say I get a 200 quid increase. Let's say I manage to sell 2,000 of my growth stocks. No. See, that doesn't affect the numbers that much, does it? 6,000. So yeah, a fair amount of the growth stocks need to be sold. 5.5 grand and 200 increase in that. Okay. Anyway, there's a little look at that spreadsheet to see how the numbers are going. And just for completeness, here's a little look at the current state of things, a day or two after the 6th of October. Everything went down on Friday. Anyway, there we go, there's a not so quick update. I'll see you next time. Bye bye.